We've got the minutes counting down until we get the new inflation figure. Politically very important,
Huge,
Andrew.
huge. One of the 5 pledges of Rishi Sunak, get inflation down, target of 2%. It's getting ever closer.
He said halve it, which they met some time ago.
They did.
Hit
Because at that point it was 11%.
11.1.
But they want to get it to 2%.
Yeah, which is good. But remember, prices are still going up.
Yeah,
you don't get back everything it went up before. You've still taken that hit on your living standards.
Yes. So we'll have the Chancellor on after 8 o'clock. Part of the reason, of course, that we expect inflation to come down is because there was an energy price cap.
So the energy price cap dropped 12% on the 1st of April, and this is the first inflation report that factors that in. Yeah. That's why CPI inflation, the main one looked at, is currently 3.2%, and the range of what it could go to today is being predicted to be between 1.9 and 2.3%. Now, what the government really want is 2%, because that's the target. And my guess is just because Jeremy Hunt is coming on, they may have met it. That's the only reason I think they may have met it.
They know it in advance. They know. Yeah. I think it's 2 days in advance.
So I think they may be coming on to say we've hit it. If it's 2.1, it'll be disappointing for them. So inflation's definitely coming down. The question is how much. But energy bills are also going to be in the news this week, because on Friday we get the announcement of the July price cap. Now, the current prediction is in July, energy bills will come down by a further 7%. The assessment period has ended, so the predictions tend to be pretty good. It might be 6, it might be 8, but 7%. But then, in October, predicted to be up 4%. In January, up 1%. So this may well be, the July announcement, may be the last price cap fall we see for a while.
And just to explain, the price cap is when the regulator tells the energy companies the maximum they can charge for a unit of energy.
The maximum they can charge for a unit of energy and the standing charges on their standard tariffs, which is what 90% of homes in England, Scotland and Wales are on. So, frankly, unless you're on a fix or you're on a special tariff, you're on the price cap. It affects your price.
What, 2.5 years ago, it was £1,200. It will still be much higher.
Well, I actually...
It's for the typical household.
I actually think that the gap is different because 2.5... Before the energy crisis, most people were on fixes, cheap fixes. So if you look at the average price people paid then to now on the same usage, you're not far from double even now. Right, because people were paying $850 on cheap fixes then.
People want some advice on their bills then, because Gaynor points out, can you ask Martin, is now a good time to switch suppliers? Lots of people asking about switching, many asking whether it's best to do it now or to wait until July for the price cap cut.
So I think there's a lot of confusion here. The price cap dictates the price of standard tariffs. So the standard tariff will drop on the 1st of July. The main alternative tariffs being offered are fixes where you lock in. Their price is not affected by the price cap. So lots of people say, should I wait to July to fix? Well, the fixed price is not affected by July. So fixes move up and down, depend on the current supply that energy firms can get based on the current wholesale rates. Now, if you were to look ahead over the next year based on the current predictions, on average, we would pay 3% less than now if you stay on the price cap. So it'll drop by 3% on average if, big if, crystal ball, the predictions are right. The cheapest fixes on the market are 9% cheaper right now. So you can lock in on the cheapest fix, make sure you do a comparison, one that shows the whole of the market, not ones that hide tariffs that don't pay them. You can lock in right now 9% cheaper, get guaranteed rates for the next year. That's cheaper than you'll be paying when it comes down in July, and it is likely to be, based on predictions, substantially cheaper than what the price cap will be over the next year. Of course, this could move if the world changes. So I would say right now, many people should be looking at fixing, because fixes are quite a lot cheaper than the prediction of the price cap. The problem when you do a comparison on most sites is they just give you the current price cap. You actually need to look at the price cap over the next year to do the comparison, and there are not many sites that do that. I can't tell you which ones do, but there are not many that do that. And so, therefore, you can fix. I would be looking at doing a comparison on a fix now and seeing what you can get. It's cheap fixes, though. People always say, it's not about getting a fix. If you're going to lock in at a cheap price. Don't lock in at an expensive price. No. Cheap as you can get.
And Vanessa asks, she's with EDF, and she says she has been told that all their fixed tariffs have compulsory smart meters. Due to where her meters are, she's been told there is no space for her to have a smart meter. Is there anything she can do?
Well, the rules usually state that you must either have or get a smart meter where practicable. And as it is not practicable for her to have a meter fitted, she should be given access to the smart meter tariff. Now, it's worth saying people often get annoyed about smart meters. There are many people who don't want them. I tend to be in favour of them, but I understand some people don't want them. Last I checked, which was 2 weeks ago, 2 of the top fixes, from memory, it was Outfox the Market and British Gas, did not require you to have a smart meter fitted to get their fixes. So there are, and that's quite rare, there were 2 weeks ago, hopefully they're still there, a couple of fixes that don't require you to have a smart meter. But in her case...
She should go back to her energy supplier.
It is not practicable for me to have it fitted, therefore I should be eligible for your smart meter cheaper tariff.
Any questions you would like to ask Martin as he's here this morning?
I've just switched.
You have just switched?
Did you fix?
Out to Outfox the Market.
On their cheaper fix?
Yeah.
Second cheapest on the market on average after electricity, but it depends on where you live and what you use, so it might be in your cheapest.
And I don't have a smart meter because it isn't practical.
About 10 o'clock, and he come round and saw all my finances out. I'll get all the documents. You can, put them in front of
Go back to school and get yourself some financial education.
I buy you a pint. What do you mean? That's not enough.
Kevin, Andrew, thanks very much.
What the cliff edge means is normally, in most benefits, if you earn £1 above a threshold, you might lose 20p of your gain type thing. Here, you earn a penny over the threshold, you lose the whole 80 quid. Now, I was going to read out, we didn't have time. I'm going to read you one from Helen Nellen on Twitter, got in touch with me. My dad is blind, his wife is his carer and works 13 hours a week minimum wage. She's been told she owes £5,000 and it's going to be taken. Her worst offence, working 50 minutes over because others didn't turn up for work. Government going after easy prey with no voice. 138,000 people are having a clawback on carers allowance, often because minimum wages went up and they didn't realise it pushed them over the threshold. A penny over the threshold, you lose the whole amount and they're claiming it back. So he's saying they're looking into the clawback system, which clearly doesn't work. But the reason the clawback happens is because there's a cliff edge, and that is an unfair form of benefits, an unfair form of tax. It doesn't work on other benefits. It needs to be changed. We put it under his nose. Let's hope if there's another fiscal event, and I'll write to the Shadow Chancellor as well on the same issue. OK. A couple of questions for you from viewers this morning. Yeah. Katrina, my low fixed mortgage expires in October. What do I do? Well, the first thing is within 6 months from it ending, you are able to get a new rate, probably from your existing lender. Most of them offer that. Now, if you can get yourself a rate now, without having to pay a fee for it, which is possible, that you can then let go of later if you want, it's often worth getting that as an insurance policy in case things go the other way. But when you're in the 6-month run-up period, clearly the hope from what we've heard today is we're going to see lower interest rates coming forward, probably a cut in August, maybe a couple of cuts. So tracker rates would get cheaper. Fixed rates haven't moved down, but the brokers are telling me, and always go to a mortgage broker if you need help on a mortgage, get your one-on-one help. Brokers are telling me they hope to see rates at around the 4% level by the end of the year. So you're in October. I would look at what you can get now, but I'd be thinking about trying to then look again and see if there's anything cheaper once you get nearer to the mortgage ending.
Christine says, why are banks putting interest rates down when the Bank of England isn't? I wonder if Christine's a saver.
Because fixed rates, both savings and mortgages, depend on swap rates, which are the city's prediction of long-term interest rates. So when you start to move to a lower interest rate environment, they predict interest rates will be lower in future. So the fixed rates come down. Good for mortgage holders, bad for fixed rate savings. So fixed rate savings are off by about 1% their highs, just like mortgage rates are off by about a percentage point from their highs too.
Leanne says, is it better if she has a loan with an interest rate of 10%, is it better to get a 0% card and pay it off that way?
You need to check the early redemption penalties on your loan. There are existing loan calculators on there. The only 0% card you could use to do this is what's called a money transfer card. I think it's only MBNA and Tesco that offer them at the moment, and you can only get around a year 0%, because your money transfer is a card that pays money into your bank account. So you've got the money in the bank account to pay off the loan, and then you owe the credit card firm instead at 0%. Most cards are balance transfers, not money transfers. It's not a competitive market. Technically, it's possible. Technically, Technically, it could work. You'd have to be able to pay it off quickly, but you need to do your reading. It's quite a financially savvy transaction to do that one.
Thank you, Martin, for being with us. Thanks to the Chancellor and all our guests this morning. Final thought?
Final thought is, you know, I hope we are turning the corner and things are improving, but in the people feeling better off, the Chancellor said at the beginning of next year, I think it's longer away than that.